As usual, just one speech by Fed Chief Jerome Powell was enough to send Bitcoin to 22,000, and the subsequent collapse of Silvergate amplified the fall in price. But this is not the biggest problem for markets, because the threat of the so-called flash crash is looming over us. Let's get to the bottom of this. Let's start with the Fed. The Lord of the Printing Press, Jerome Powell, spoke to Congress for 2 whole days on March 7th and 8th. Then the odds of a 50-point hike at the March 22nd meeting went from 20 to 80%. So what happened? How did markets react? And why does it matter? Here are the key quotes from his speech that got investors so excited. The latest economic data was stronger than expected, suggesting that the final interest rate level will probably be higher than previously expected, which makes double sense. It's about the fact that inflation itself was higher than expected, and also that the economy is showing active resistance to regulatory action. I mean, the Fed said many times that it has plans to raise the unemployment rate, but it remains record low. And according to the forecast for this Friday, we will have strong labor market statistics again tomorrow, so be prepared for another high volatility in the markets tomorrow. The next big day is the release of inflation data on March 14th, another important quote from Powell's speech. And if the aggregate data indicated that faster tightening was warranted, we would be willing to increase the pace of rate hikes. And let's add to it right away another thing: we have overcome a lot of work, and all the effects of our tightening have yet to be felt. Nevertheless, we still have some work to do. There are 2 major fears of the markets at once. The first is that the Fed could go back to the big and step of raising rates. Let me remind you that at the last meeting they did everything plus 25 points, and many were expecting this to be the last rate hike at all. And the second point is that Powell is hinting at a maximum rate hike this year, much higher than the market had previously expected, maybe as high as 6%. And the final argument from the Fed: we're taking the only measures we have to bring inflation down. Would working people be better off if we stopped? And inflation stayed at 5.6%. Here, Powell explains that if inflation is high, the regulator Trivial has no other tools to slow it down except to raise the rate and drive the economy into recession. This seems like a bad solution in the short term. He writes that long-term high inflation is far more dangerous to your wealth than high rates. It is the threat of such high and what's called sticky inflation that has taken shape right now, when your savings will depreciate by 5% or more every year. Besides, a recession, it's not just a slowdown in the economy. It is still a chance to enter the market successfully at low prices, which is also what the trader is alluding to. Let's take the Silvergate bankruptcy story further. After all, this is where Bitcoin fell below $22,000, after which I will talk about the main threat to the market called flash crash. Let me remind you that Silvergate is a fully regulated bank that bet on working with cryptocurrency companies and lost. It is now officially known that Silvergate did not survive its first bear market and will be liquidated. It was through Silvergate that Dollar, Coinbase, Gemineus, Crypto.com, and other exchanges conducted their transactions, and many feared that the bank would pull the exchanges to the bottom. But so far, there are no prerequisites for that. According to the preliminary information, the bank will fulfill all its obligations and there will be no collapse. But if we look at the situation from a different angle, there are 2 unpleasant consequences. First, remember the news that Bybit curtailed its cash dollar operations. So this is because of the need to work through a bank, and now it will be very hard for crypto exchanges to find a new financial partner. And secondly, this whole story is a great excuse for regulators to tighten the screws even more. So cryptocurrencies were brought up again in the Biden administration. They announced the introduction of new measures to regulate the industry in order to stop the circumvention of sanctions and money laundering through digital assets. But they also plan to increase tax controls on the crypto industry and traders. And they want to shell out a tidy sum of $24 billion to investors. That is the future we can expect in the near future. Biden will come and take it away in the form of taxes. Moving on to the final part. I've already shown you in previous videos that on a weekly chart, Bitcoin could take a local decline to $20,000 after the events that we've already discussed. That trend has intensified. Bitcoin does not yet have its own reason for a rise in price, and with the industry continuing to be in a state of new bankruptcies, there is no reason to expect a positive. In that case, the problem for cryptocurrencies could be a sharp stock market crash. After Powell went back into hawk mode, we saw a correction in the S&P 500, which doesn't really look like a disaster for bulls. A reversal in Fed policy on the chart draws just a retail of the downtrend that was recently broken. You can't get very far on tight monetary policy. In fact, it's a good thing that the markets have started to put this negativity in the price in advance. Thus, when on March 14th, the data on inflation will be released, and if they turn out to be much worse than expected, we will be protected from a sharp fall in stocks, and as a consequence, in cryptocurrencies. Exactly the same principle will work on March 22nd. When the Fed is likely to decide to raise the rate again by 50 points, the markets will already be ready for it. That is, for now, there is no need to shout a sentinel, and there are even chances for a rebound. However, the analysts of JP Morgan warn about the possibility of the scenario called flash crash, when the prices at one moment fall by 20% or more. According to their estimates, if the S&P 500 index experiences a 5% sell-off during the day, it could trigger a flood of liquidation of day options for as much as $1 trillion, which could cause the stock market to collapse by 25% at once. Well, Bitcoin for the company would react in a similar way. Probably the most appropriate example in the history of the first cryptocurrency. This is March of 2020th year, when the stock market fell by 40% in one day. The events the Fed is preparing us for are not enough for a flash crash scenario. Even a confirmed recession would not cause such a sell-off, but in theory it could happen due to the bankruptcy of a major player like JP Morgan. So we keep an eye on the situation. You never know what surprises await us in the future. Sign up to stay informed. Your cryptocurrency.